Good day, folks. Today we're going to talk about the quality of financial information. As a recap, the objective of financial reporting is to provide information to existing and potential investors, lenders, and other creditors. We've been talking about this throughout the course. What's the purpose of financial analysis? We're now going to take a look at financial reporting, which gives us the information of which our analysis is based on. And these we can end up using, as you know, to buy, sell, or hold securities, expectations about the company, expectation about returns, entity's cash flow. So we need to know what these resources the company has, claims on resources, how has the management of the firm, led by the board of directors, using the resources. They're not financial reports prepared are not designed to show the value of reporting entity. They provide information to help users estimate the value of the reporting. They don't provide all of the information that we need, as you have already seen. So we use not only the 10K, but we use investor presentation, we use news articles, analyst reports, etc. But let's focus in a little bit on accountants' reports. Accountants issue three types of reports. The first one is a compiled financial report. And that is they simply took information and presented it in financial statement format. This is done for very small companies. It's very simple, and it's fairly cost effective for the company. Review. That's you took information, you performed a review and asked questions. You don't express an opinion. There's no test of transactions or verifications, but you review it. Make sure there's notes there, it's presented in financial, and ask high-level questions about things. Then there's audit reports, and they express an opinion. When we're dealing with publicly held companies, it's always an audited report. Now, the auditor's report is a written opinion. It's written on the financial statements that's prepared by the independent auditor. The objective is to obtain reasonable, note the word reasonable, assurance about whether the financial statements as a whole are free from material misstatement. Okay, that's important. As a whole, put all together, and material misstatement. In order for the auditor to give an opinion on whether the statements are prepared in accordance with applicable financial standards or framework, consistently applied. So we're trying to understand that there's a reasonable assurance there that the work we're looking at is free from material misstatement. Okay? Material. And it's prepared in accordance with applicable financial standard. And then to report on the financial statements. There are three types of basic opinions. Unqualified, audit opinion, clean opinion. It states that the financial statements give a true and fair view. That's the international term. And fairly presented, which is used in internet, but primarily in GAAP, in accordance with applicable accounting standards. This is what we would expect to see. Then there is a adverse opinion, and that's one where there's a material departure from accounting standards and are not fairly presented. We wouldn't generally look at those. There's a disclaimer of opinion, and that's issued when the auditors are unable to issue an opinion for some reason, such as a scope limitation. They weren't able to observe inventory or something. So these are the broad, and when we start looking at an audit report, we're going to see that there's a lot of different pieces that go into it. The other type of report that we let's just go through the clean report. There's an introductory paragraph, and that's what it is, and responsibility of the auditor. What's management's responsibility? We'll take a look at some of these. Audit in accordance with PCAOB standards, and that's the regulatory body for publicly held companies. A description of the audit, okay? And then the audit provides reasonable basis for opinion. So that's the scope paragraph. So introduction, scope, opinion, fairly presented. This is the key one we're looking for. But then they also get into internal controls. So that's a clean report. The next one is a qualified opinion. And this is one that we will see more often than not. And that is single deviation for GAAP, except for at least one area it does not conform, but the rest are. Okay, so that would be a single deviation. Here's a limitation of scope. Again, relative to a very narrow segment. They weren't able to do something. Usually a qualified opinion that are fairly accept material but not pervasive area. When we get into a qualified opinion, that can also include a going concern. Is the business a going concern? Because if it's not a going concern, there are certain other things that may need to be implemented, such as recording assets at fair market value, taking losses. Adverse opinion, we talked about, does not conform. It's contrast to the unqualified, where it's both material and pervasive errors. We don't usually see them. And then there is disclaimer of the audit report. Then they take a look at the internal control system of the firm, and that's the system that the company has designed and built and is executing to ensure that the processes for generating financial reports is sound. Okay? And that could include such things as reconciling the bank, making sure that cash checks or disbursements are properly approved, there's proper accounts to which one it's in, that it's reconciled back to the bank, and that's such things. In the United States, an audit opinion on the company's internal control is also required. We're going to take a look at Constellation Brands, and here is, this is from their 10K, financial statements and supplemental data. You've already looked through sort of the balance sheets, income statements, notes, and all that. But what we're going to start with is, let's just take a look at the actual reporting from a verbiage as you begin. First thing is, management is giving in a report of internal controls over financial reporting. This is the key. Management of Constellation Brands is responsible for establishing and maintaining an adequate system of internal control over financial reporting. The system is designed to provide reasonable assurance regarding the reliability of financial reporting and preparation of financial statements in accordance. So they're taking responsibility. And they define this out as being policies and procedures, records reasonable that transactions are recorded as necessary to permit them. Okay, transactions are authorized, provide reasonable assurance about the prevention or timely detection of unauthorized transactions. Because of its limit, there appears a scope limit. This is literally a limitation here. Provide only reasonable assurance. It may not always detect or prevent fraud. And it varies over time. And they said they did this this is how they did it. And then, so they're saying it's our responsibilities. Here's what we did. If we move down to the actual report, it's addressed to the stockholders and board of directors. First thing, their opinion on internal control. They audit it based on standards established, internal control, integrated framework. Okay. We have audited in accordance with standards of the Public Company Accounting Oversight Boards, the consolidated balance sheet, boom, 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 and we expressed an unqualified opinion on those consolidated. So they're saying, yes, we've looked at them. Basis for opinion is management is responsible for maintaining effective control, okay, including the annual report on internal control over financial. Our responsibility, narrowing it down, is to express an opinion on the company's internal control. They say they're a publicly accounting firm registered with PCAOB, and they're independent. They did an audit in accordance with these standards. They plan and perform the audit that they obtained reasonable assurance as to whether the internal control system is working. We believe that our audit provides a reasonable basis for our opinion. They now talk about what it's designed to do, and that's really the same thing that management told us. Because of its inherent limitations, we have that. So that's the opinion on internal controls. Okay, so making sure the process in place is probably the most important part of the audit. Now we come back to the stockholders and board of directors once again. Opinion on the consolidated financial statements. The one before that was just on the internal controls. And this is we have audited, in our opinion, the consolidated financial statements present fairly, in all material respects, the financial position of the company as of February 28th. Boom. Okay, the basis for opinion, here's what they've done. And note that they've served as the company as auditor from 2002. We're seeing more of that. So that's the opinion of the auditor. When we look at this, the importance of this is that complexity involved in setting standards reflects the complexity of the underlying economic reality. It's not always easy to come up with financial standards because some transactions are very unique and they're very complex. And I think we see some of that in the disclosure, ASC 606, and other things as new transactions keep coming out that the accounting has to be applied. A number of years ago, well, probably more than a number of years ago, probably over 30 years ago, we didn't have any accounting for futures, forwards, options, and swaps. So the banks, and I was working on this with members of the New York Clearinghouse, is how do we account for some of these transactions? We didn't know. So very complex. And it took a while to understand what was happening, to properly classify them. So that's the complexity in the standards. Next one is complexity and uncertain, that judgment comes in. You're using certain assumptions to come up with something. And that's judgment. So standards are trying to achieve some level of consistency or comparability. And even if you can have a general framework of this is how to do it, we're using estimates. And we'll take a further look at this when we look at Kraft Heinz. By understanding how and when standards require judgments, will give us as analysts the ability to make better use of that information. What should we be looking for? Next one is the Public Company Accounting Oversight Board, PCAOB. It establishes auditing and related practices for registered public accountant firms that prepare and issue audit reports on publicly held companies. Okay. Here is a report by KPMG, and you can link this. You can also go to the site to find any other firms that you would like to. And in this, we found there were a number of issues that came back that KPMG did a couple of things wrong. And I think if you go to the article presentation, Mike and George did a great job in summarizing what was going on there. So instead of me repeating it, I'm just going to tell you to go look at that article presentation by George and Mike. Then we have standard setting bodies and regulatory authorities. They're two different things. Standard setting are independent, created by the profession themselves. That's the Financial Accounting Standard Board. And then there's the regulatory authorities. Okay, standard setting bodies set the standards. Okay, regulatory authorities recognize and enforce the standards. At times, though, we do see that the regulatory authorities do override the private sector standard setting bodies or go into more depth or require more disclosure. So standard setting bodies set the standards, regulatory authorities recognize and enforce the standards. In the standard setting bodies, there's two: the International Accounting Standards Board, IASB, and that sets IFRS, International Financial Reporting Standards. The U.S. Financial Accounting Standards Board, FASB, sets U.S. GAAP, Generally Accepted Accounting Principles. So those are the standard setting boards. Then we have each country has regulatory authorities. Now, you're going to find that each regulatory authority isn't the same. They all do a little job, but their job is to enforce, monitor, and ensure compliance with that, as well as make some of their own rules. And what we can see here is that the Securities and Exchange Commission, the SEC, is the regulatory body in the U.S., and most of that is, the foundation for that is in the Securities and Exchange Commission Act of 1933 and 1934.